Hi, I'm Ed Harrison, your host here. I am talking to David Enrich, who is the author of the recently released and acclaimed book, Dark Towers. It's about Deutsche Bank. Welcome.
Thanks for having me.
So I think this is a really great book, and as an aside, I used to work for Deutsche Bank a long, long time ago. So I'm really interested in diving into some of the transformations there because I was there on the scene and saw some of the things that were happening. What led you to write the book?
I've been obsessing kind of unhealthily about Deutsche Bank probably for the past decade, believe it or not. And I moved to London. I was working with the Wall Street Journal at the time. I moved there in 2010. Right after the global financial crisis, but right at the dawn of the European financial crisis. And Deutsche Bank was looming over Europe as this kind of big, dark, impenetrable cloud. And as a journalist, there is nothing that attracts an investigative reporter more than a big, dark, impenetrable cloud. And so there was Deutsche Bank, and I really wanted to get inside of that dark, impenetrable cloud, and struggled for many years to do so. But I had been focusing on the bank and its financial problems and its opacity for a really long time, and ultimately that yielded this book.
Yeah, and I think we were talking just before the camera started rolling about how a lot of the mainstream outlets will focus on the Trump factor, and we'll certainly get into that. But I think, from my perspective, it's really about the financial system. And I want to go back to the transformation that Deutsche has made over the last 20, 25 years to get a sense of how that bank's transformed and how that's emblematic of the transformation that we've seen in the system. What did Deutsche Bank look like before it became this giant financial behemoth?
So let me just say before I even answer that I think that's like a really good approach, because Deutsche Bank in a lot of ways, it's an interesting tale of its rise and fall, but it also is just this nearly perfect case study in how not to run a major global financial institution or a major global company of any nature, really. So I think it's a pretty interesting tale. So Deutsche Bank was founded in 1870. This is its 150th birthday. Happy birthday, Deutsche Bank. And it was founded as basically an institution that was supposed to help German companies spread their wings internationally. And this was the dawn of the industrial era. And so there were big, proud German companies like Siemens in particular that were looking for a German bank that could help finance their projects all over the world, really. And so that's what Deutsche Bank was doing. It was also financing infrastructure projects really basically in most continents, in South America, in the US, all over Europe and Asia. And so it was a pretty traditional institutional lender that was really helping the economy grow at a point in world history where there was a lot of economic growth to be had. And that trajectory went on basically uninterrupted for about 6 decades. And Deutsche Bank was becoming one of the biggest banks in the world, even at that point. And this is obviously an era before globalization. So banks were much more national or continental in nature than they are today. But it was becoming one of the biggest, most important financiers of infrastructure and development and industrial projects anywhere in the world. And then in the 1930s, the Nazis come to power in Germany, and Deutsche Bank goes from being this kind of international development bank to being the financial wing of the Nazi Party, essentially. And it helps bankroll the German military. It helps pay for the construction of concentration camps. It helps pay for the manufacture of poison gas and for selling gold, some of which was extracted from the teeth of Jews for the Nazis all over Europe and Asia. And so it very quickly goes from being this global bank to being one that is focused on helping Germany take over the globe. Which, in fairness to Deutsche Bank, was something a lot of big German companies were doing at the time.
And they were basically co-opted into it because, state capitalism, that's what the National Socialism was, right?
Yeah, that's absolutely right. Although I would argue, especially with the benefit of hindsight, that this was an institution, and these were executives at this institution who got pretty caught up in it as well. They were not members of the Nazi Party, but one of the bank's leaders at the time was serving on the board not just of Deutsche Bank, but of the chemical company that was manufacturing the gas. So this is not a case of them just following orders. This is a case of them looking to continue to thrive in an era where thriving meant being complicit in genocide. So that's a trade that they made. And after the war, they were accused, the institution was accused of being a war criminal, and its leader was convicted of being a war criminal. And the US tried to liquidate the bank. And that would have been the end of Deutsche Bank, except that the British government, which was still owed reparations from World War I from Germany, really wanted Deutsche Bank to exist and to help basically pull Germany out of this deep depression that was in, help rebuild Germany, and help rebuild and reunite Europe. And so the Brits prevailed, and Deutsche Bank over the next several decades became, once again, one of the leading financiers of development, infrastructure, and kind of corporate projects all over Europe. And it played a really leading, important role in the reconstruction, redevelopment, and ultimately the reunification of Europe.
Right. And where were the French, by the way, during that period of time? What were they thinking about? Because my understanding is they were against letting the Germans sort of rise up, if you will.
Yeah, the French had some trust issues with the Germans at that point.
Yeah.
It's interesting. I actually don't know the answer to what the French view on the liquidation versus maintenance of Deutsche Bank was. And it was interesting because Berlin obviously was split into quadrants, right?
Right.
And the Deutsche Bank's old headquarters happened to be in the British quadrant. And that was a very fateful, kind of random outcome, but it meant that the Brits ultimately were the ones who had a say over what was going to happen with this bank. And so it didn't just get right back to normal. It was actually split into 10 or 11 different little institutions, but they all continued to operate basically under the Deutsche Bank umbrella. And within less than 10 years, they were legally and formally reunited themselves.
And Deutsche Bank, Deutsche means German, and when people think of the bank that is Germany, that's the first bank that they think of. So the leading German bank in terms of, as you said, bringing Europe back together, reunification. When we get to the reunification period and beyond, what does Deutsche Bank look like compared to, say, other national banks, the likes of UBS or of BNP Paribas and those kinds of institutions?
So through the 1980s, the banking industry was really a pale comparison of what it became in the 90s, 2000s, and even today. And these kind of leading national champion banks, whether it's in Germany or Switzerland or France or the UK, are really much more traditional lenders than what we've seen today. I mean, they're providing slightly different services depending on the geography. I mean, the Swiss were always really big in wealth management, for example. But these were banks that had, in Deutsche Bank's case, a limited retail presence. So they'd been founded, by the way, with zero interest in serving retail customers. This was purely an institutional focused bank. And it remained that way for the most part. And they did have a retail franchise, but it was not that exciting, in part because retail banking in Germany is not very lucrative. And I think the same goes for the international footprint of a BNP Paribas or a UBS or a Deutsche Bank. It was in serving big companies from their home countries and from the continent, helping them finance projects overseas. And it was a pretty plain vanilla type of business activity. And that increasingly into the late 80s became a problem for banks like Deutsche Bank because the world was globalizing at this point, and it was becoming much easier for investors to, whether they were in Germany or the US or Hong Kong, to have a choice in where they put their money. And if they wanted a certain amount of exposure to a big international bank, they obviously are going to look for the investment opportunity that presents the highest returns. So if you're an investor that's in Germany, but in usage it's automatically have a choice between 2 or 3 big German banks, you've now got a menu that spans the globe pretty much. And so banks like Deutsche Bank were looking and watching with increasing envy and alarm as US banks, especially the old Wall Street partnerships, converted into publicly traded companies and were just minting money and had returns on equity that were orders of magnitude higher than what Deutsche Bank was achieving. And the same goes for UBS or BNP Paribas or any number, Barclays in the UK. And so the solution to that at the time was pretty simple. It was that banks like Deutsche Bank needed to get into the same game that that allowed the Goldmans and the JP Morgans and the Citigroups of the world to be just raking in the revenue. And that was Wall Street. And it was investment banking, it was sales and trading, and it just opened up this entire new world of opportunity for these banks.
So that's basically when it all started. That's when the transformation happened. And what time period are you talking about? Who was at the helm at Deutsche at that time?
The CEO of Deutsche Bank at the time was a guy named Alfred Harrison, who was, he had been, and he was kind of a statesman in Germany and internationally. He was one of the world's leading advocates for the forgiveness of third world debts, for example. So this was someone who took a very kind of global and almost diplomatic role or view of his role and his bank's role in world affairs. He wanted to make money, but he also viewed Deutsche Bank as having this kind of historical responsibility for making the world a better place. And the view was that in the long run, that's good for profits for Deutsche Bank, because if the global economy is growing, that lifts the financial system along with it. And so he kind of dove into this by buying in 1989 this venerable British investment bank called Morgan Grenfell, which was an offshoot of the old JP Morgan empire. And that was a first kind of baby step that Deutsche Bank took into the wild Western world of investment banking and sales and trading. But it was a very small step. And
right.
Within several years of that, it became clear. Harrison, by the way, was assassinated barely a week after announcing the Morgan Grenfell acquisition, because he was viewed as this great symbol in Germany, this symbol of global capitalism. And so he was assassinated by I think it was a group called the
RAF.
Yeah, the Red Army Fascists. Is that or faction?
That's right.
Yeah.
Right.
So which was trying to kind of view Deutsche Bank as the, I guess, kind of the vampire squid of the time.
Right.
And that turned out to be, I mean, obviously assassinating people is not a good policy decision for the most part, but in this case it turned out to be especially bad, because Harrison's replacements were people who viewed Deutsche Bank's mission as much narrower,
right,
and much more oriented toward maximizing short-term profits than Harrison, the statesman, had viewed it. And so the mission of Deutsche Bank went from under Harrison and his predecessors. It was that their goal is to serve a bunch of different constituencies. Shareholders are one of them, but so are customers, so are employees, so are the communities in which the bank operates, so is really the global community. And it went from being that kind of broad, holistic view of things to being a much narrower vision, which is that we exist to serve our shareholders, and in the short term in particular. Right. And so a succession of executives after Harrison's assassination they really stepped on the gas and dove headfirst into Wall Street and the City of London as really the defining kind of generational opportunities that they faced. And the result initially was very successful. Deutsche Bank went from being essentially a non-contender on Wall Street in the City of London within several years, and having spent billions of dollars hiring people in the US and in London, became a formidable competitor to the really established Wall Street banks. It was one of what I describe in the book as one of the great migrations in Wall Street history, where they are the leaders of Deutsche Bank, who themselves are Credit Suisse or Merrill veterans, are hiring thousands and thousands of people in a matter of months to come build from the ground up this swashbuckling new investment bank.
And, actually, we were talking about this maybe 2 days ago, and I was telling you that's when I came to Deutsche Bank in the late 90s. It was under, I think Breuer was the head at that time, and Edson Mitchell was a Merrill guy, was the guy who was bringing all the swashbucklers in. He brought in Andrew Jain, who later became the CEO. But it was under the guise of Deutsche Morgan Grenfell. So they took the Morgan Grenfell acquisition and made it into this is who we are now. And as I remember, that was exactly what all the other investment banks were doing. SBC, Warburg, there was Dylan Reed.
That's right.
We had Hor Govet, who went on with...
Well, that is a name I haven't heard in quite some time.
And so all of the continental banks were taking these investment banks in the UK and saying, look, now we are just as good as the Americans. We have this Anglo-American thing, and we're going to do it in London. it seemed that London was the place to be.
Well, London's the middle of the world, right? It's in a lot of ways. It's the middle. It's a time zone that bridges Europe or bridges Asia and the U.S. It's a melting pot. You have great, easy access to markets all over Europe, Middle East, and Africa. And also, it just traditionally, going back many centuries, is a global financial crossroads for the world. And yeah, so this became, especially for European banks, London became this new financial hub where, through a combination of acquisitions and very aggressive hiring, all of these banks started to remodel themselves in the Wall Street model. And I would argue none more successfully and comprehensively than Deutsche Bank. Well, go ahead.
And what does that mean? Like the Wall Street model, what was different about the Wall Street model than the model that Deutsche and these other banks had before?
Well, there was just, for the most part, they didn't have big sales and trading operations.
Right.
They would help Deutsche Bank let's say pre-1989, or probably even pre-1995, if they had a big European client that wanted to say, I don't know, wanted a loan to build a railroad in Brazil, Deutsche Bank would probably provide the loan to do that. What it would not do, though, is provide any sort of hedging services. So it wouldn't provide derivatives to protect them against swings in interest rates or any political or kind of environmental or weather instability, anything like that. It wouldn't provide foreign currency services on any kind of sophisticated level. It maybe would help convert dollars into Deutschmarks into, I don't know, other currencies, but it's not providing any sort of
advanced, sort of like bespoke type of services.
Yeah, nor is it helping the companies deal with the in a sophisticated way anyway of having an increasingly global workforce. So it was built for a very simple time when a company would come to Deutsche Bank and need a loan to finance a particular project in a particular part of the world. And that's a pretty simple solution to provide. You kind of underwrite the loan, you look at the risks, and then you set interest rates and loan terms based on the risks so that you make a profit. But it's a very very simple service to provide. And it was just being left behind by these Wall Street banks that could come in, offer these products with all these bells and whistles that were offering the prospect of more or less complete protection from any uncertainty in the future. And for that privilege, the banks would charge very rich fees.
Right.
And but look, those are valuable services, right? If you can eliminate risk from a business, that's kind of the holy grail of capitalism, right? And of course, it didn't quite work out that way, but Deutsche Bank viewed the rich pool of profits that awaited and the ability to be able to serve their clients and new clients in a comprehensive global way as a very attractive proposition. And I think that was part of what lured all these other banks down this similar path as well.
You know, I mean, ostensibly their huge balance sheets are a benefit to them relative to the likes of Morgan Stanley, Merrill Lynch, or Goldman Sachs, who were the guys who were coming in along with JP Morgan. JP Morgan obviously had the balance sheet as well. So,
right, especially at that time, before Goldman and Morgan Stanley became banks, Deutsche Bank had, like some of its competitors, had this ability they were taking in huge amounts through deposits and through ability to borrow on the markets that they could then lend out or use for other purposes at a much lower cost than a Goldman or a Morgan Stanley.
Right.
And so that provided them a huge advantage, and their balance sheet grew very quickly as a result of doing that. And for a while, as long as it was kind of a benign macroeconomic environment and a benign regulatory environment, this was a very easy way to very quickly become a global player.
And so, I mean, that begs the question that my next question was, it sounds great. So what went wrong? I mean, when we talk about the Trump connection is emblematic of what went wrong, what was it that went wrong at Deutsche Bank?
Well, what went wrong is that starting in the mid to late 90s, a succession of top executives, none more so than Joe Ackerman, who was the CEO from 2002 to 2012, just completely lost sight of any, they stopped having anything resembling a long-term view of the business. They began operating with an obsessive and singular focus on short-term profits. And that sounds simple and it sounds kind of obvious, but it took over the bank. And
can you give me an example?
yeah, so Ackerman in, I think, 2003 decided, he became CEO, and he decided that the way to increase Deutsche Bank's stock price in the short term was to substantially increase the bank's return on equity. So that's basically the profits that go to shareholders, essentially. And it was at that moment, I believe it was 4% the return on equity, which is a very low number.
Yes.
And he wanted it within 2 or 3 years to hit 25%.
25%.
So he wanted to go up sixfold. And that's, look, 4% is very low, but 25% is very high, especially for a financial institution that's supposed to be playing this kind of intermediary role in the financial system and the economy.
And especially given the size of its balance sheet as well.
And given how achieving something like that in the space of 24 or 36 months requires, like, stepping on the gas isn't really the right analogy. It's like turning on like the rocket engines and then like tossing some, like, I don't know, explosives in there with it and seeing what happens. And that's basically what happened. Deutsche Bank, first of all, they achieved these milestones on the schedule, on Ackerman's schedule, which was quite impressive. But they did it at a very expensive long-term proposition, which was that they stopped investing in anything that cost money. And so that means they stopped investing in technology, their internal technology systems, as they hired teams of traders and sales guys, and as they made acquisitions. They went from having a small handful of technology systems to having several hundred, probably more than 1,000 technology systems inside the bank. And these are computer systems that don't talk to each other, so it becomes almost impossible. If you ask a seemingly simple question like, what is Deutsche Bank's exposure to, I don't know, Greece? There's no answer.
Right.
Or there is an answer, there's just no way to figure out what the answer is, which is a terrifying prospect for if you're a bank CFO, or if you're an investor in a bank, or if you're a regulator of a bank. They didn't invest in compliance. And so because it's compliance and anti-money laundering staffs, those are cost centers. They're expensive to hire, they're expensive to train, and they literally cost you business. Their job is to say no to transactions. And if you're trying year after year, quarter after quarter, to hit these very aggressive profit milestones, that just gets in the way. I think the most important thing, though, is that the financial incentives up and down the hierarchy at the bank change very rapidly to reward this short-term return on equity goal. And the way that would happen is that bankers, traders, and just like even someone working in a Deutsche Bank branch in the middle of Germany, they no longer were just doing business with whomever seemed like a good credit risk. They were told to evaluate all relationships on the basis of a simple question, which was, will this relationship or this transaction generate a 25% return for the bank?
Right.
And most don't, right? Generally, banks are not earning 25% returns on normal transactions, nor should they be, by the way. I mean, that's
a huge number for a staid business.
Yeah, and it means that they're either drastically overcharging their customers, which just isn't going to work because their customers will go to a bank that's charging lower fees or lower interest rates, or it requires you, and this is the path the bank ultimately took, to rip off your customers, to break the law, to act without any sense of ethics. And that is exactly what they did. And the seeds were sown for this great kind of catastrophic parade of financial scandals that the bank years later would find itself immersed in. And at the time, that was a direct result of people, again, up and down the hierarchy, being told, this is serious. You need to achieve these targets. You yourself, your group, your team, your division, the company needs to hit these targets, or else Joe Ackerman, who has this terrifying temper and has a tendency at times of calling people out in public for their failures, is going to potentially fire you or humiliate you or just get extremely angry at you. And financial incentives within the bank were changed so that people's compensation was based on hitting these targets. And humans respond to incentives. And that's simple, and I think also probably the most important determinant of success or failure within these institutions. People are given financial incentives, and they respond to those incentives in fairly predictable ways. And in this case, the incentives were clear. It was to maximize short-term profits, do not worry about the next quarter or the next year, much less 5 years down the road. hit the targets now or else.
And that reminds me, as you say that, just as an aside, of Wells Fargo and all the things that we know about what happened with regard to the fake accounts and things like that. You incentivize a certain behavior, and sometimes you get those kinds of outcomes.
Yeah, it turns out that if you're telling branch managers that you need to open X number of accounts in a month or a quarter,
they're going to do that.
They're going to do it. And they're not going to, and if you're not incentivizing them not to break the law or rip off their customers or act unethically, this is very simple human psychology. It's not even human psychology, it's basic economics, right? You're going to, when you reward people for behaving in a certain way, they, all else being equal, will behave in that certain way.
When you were talking about all the different ways that they can hit this 25% bogey, the one thing that I wanted you to say, and that we're going to talk about, is they could also go out the risk curve and start dealing with customers who are riskier than others. Because to me, that's where Trump enters the picture.
Oh, that's exactly where Trump enters the picture. I mean, the relationship between Deutsche Bank and Trump started in 1998, just as the bank was trying to carve out room for itself in the United States market. And basically the way to do that for Deutsche Bank was they needed to find customers that were, for one reason or another, not bankable or not banked by kind of the better established players on Wall Street or in the US market.
And let me just drill down on that for a second, because when you say that they needed to find customers who weren't banked by other banks, why is that? Why couldn't they just go up to offer better rates to great
because
customers?
Offering better rates isn't profitable, right? You want to offer high rates, and you don't want to get into this bidding war with the rest of Wall Street, where they have better relationships, they have deeper kind of rosters of clients, and they have more employees. They have much greater sophistication and much greater reputations. You want clients who basically don't have a choice. You can charge them more, and they'll be really loyal to you. And Trump at this time was just coming off a series of defaults on his Atlantic City casinos, and his companies had declared bankruptcy a number of times, and not surprisingly, those are things that do not make you particularly attractive as a potential borrower for a mainstream bank. And so he was really eager to be shifting his business from being this casino guy to being a big New York real estate developer. And to do that, it was absolutely essential that he establish a good relationship with a major bank that would finance what he was hoping was going to be a buying and development spree in Manhattan and elsewhere. And so he meets Deutsche Bank, and it is essentially a match made in heaven. That Trump gets what he wants, Deutsche Bank gets what it wants, and off to the races they go.
So what went wrong with that relationship? When you looked through and uncovered how that relationship formed, I mean, it all seems, he's now the president of the United States. Deutsche Bank was sitting pretty after the financial crisis.
Well, within a couple of years of Deutsche Bank starting to lend hundreds of millions of dollars to Trump, the predictable begins to happen, which is that Trump, as is his wont to do at this point, starts defaulting on debt. And the first time he did this, Deutsche Bank had arranged, I believe it was a $400 million junk bond offer for one of his casino companies. And it was a really hard sell for the Deutsche Bank sales guys who were doing this. They ended up having to really jack up the interest rates on the bonds to find buyers. And Trump actually, this is one of my favorite little tales from this book. And Trump the sales guys had basically given up. They did a road show with Trump, and there were no buyers for the bonds. And so Trump requests a meeting with the sales team, which he's granted. And he comes in and he says, listen, guys, I know this is not the easiest deal to pull off, but if you can do this deal, if you can sell these 480 million bonds, or whatever it was, you will be, not only will you get paid, but you will be my personal guests for the weekend at Mar-a-Lago. And talking about incentives, these are bankers and sales guys who are getting paid a lot of money. And yet here's something that money cannot even buy. Being Trump's personal guest, getting flown down there on his 727 and spending the weekend with him was something quite special. And it actually did the trick. And the bankers did the deal. And afterwards, just as an aside, the kind of guy who was running this desk reminded Trump, he said, we pulled this off. Now don't forget what you promised my guys. And Trump is like, what did I promise? And he kind of tried to wriggle out of the agreement. He did eventually come through, and he flew everyone down to Mar-a-Lago, and it was a great weekend together. And then a few months later, he defaults.
Wow,
and so
nice.
Deutsche Bank, that doesn't cost Deutsche Bank money, but it means that all of the customers to which they had just sold these bonds get screwed. And that is the end of this particular arm of Deutsche Bank doing business with Donald Trump going forward. But it doesn't derail the overall relationship with the bank, because within Deutsche Bank, remember, people are compensated not based on the entire company's performance. They're based on their comp is based on a much narrower band, which is their personal performance or their team's performance. And so this does not change the equation for people, in this case, in the commercial real estate business at Deutsche Bank, which are still very eager to strike up a profitable relationship with Trump. And in 2005, they do it once more. They do this $640 million loan to finance the construction of a huge tower in downtown Chicago. And once again, Trump is whining and dining the bankers and showing them a great time, and they do the deal, and everyone's happy for about 2.5 years. And then the financial crisis hits in 2008. And Trump asks for a 6-month extension, which he's granted. And then the final due date comes in November of 2008. And Trump owes a lot of money, including $40 million that he had personally guaranteed. So that was connected to his personal assets. And what does he do? He looks around. Alan Greenspan had just referred to the financial crisis as a credit tsunami. And Trump has his lawyers go through the fine print of the loan documents. And in the loan documents is this kind of very typical provision, an act of God provision, that means that if there's an unanticipated natural disaster or something like a tsunami, for example, it can void aspects of the contract. And so Trump sues Deutsche Bank, claiming that the credit tsunami that Greenspan had just described constitutes a contract voiding act of God. He then sues Deutsche Bank for seeking $3 billion in damages, accusing Deutsche Bank of having caused the financial crisis and of having engaged in predatory lending practices against him, Donald Trump, by trying to collect on the loan that he owed them. And so once again, we have an arm of Deutsche Bank. In fact, this time it was really the whole bank saying, this is humiliating. We're done with Donald Trump. And eventually the litigation gets settled, and Trump agrees that by 2012 or so, he has to repay a substantial portion of what he still owes, including the $40 million that he personally guaranteed. And Trump is once again in a situation where he needs to find another bank if he's going to continue building and buying stuff. And if he's not going to use his own money to repay Deutsche Bank, he needs to find a bank. And no one's going to touch him because he keeps defaulting in a very public way. And what does he do? Well, he goes to a third arm of Deutsche Bank, in this case, the private banking division, and strikes up yet another relationship and gets Deutsche Bank. And this causes.
And what year is this?
This is 2011. And so the private banking division, which is what caters to the richest of the rich, basically, wants to reestablish a relationship with Trump. And this goes up the chain of command of the bank, and a huge fight erupts because the investment banking and the commercial real estate guys and the sales and trading guys are saying, no way can you do this. I mean, and not only don't do it because it's not smart, but this is humiliating for us. Like, we have already been burned by this guy repeatedly at this point. Why on earth would he do this? And the CEO, Joe Ackerman, still finally gets to him and he says, go ahead, do it. And so the first loan that Deutsche Bank does in this new relationship is a $48 million loan to Trump that he uses to repay what he still owed this other arm of Deutsche Bank for the defaulted loan. And that is, I have never seen anything like that. And one arm of the bank giving tens of millions of dollars to a guy who's already defaulted to repay this other arm of the bank. That is, I mean, most institutions would not. In fact, I think almost any financial institution would not do that in a million years.
Well, let me play devil's advocate here for a second. And what I'm going to say is that maybe this is when you look at deregulation and all these kinds of things, and the fact that Deutsche Bank was trying to get into the U.S. market, this is a microcosm of what was happening in the U.S., that the lax regulatory environment and their need to get customers caused them to do that. That if it were in, say, Germany or the UK, it wouldn't have happened.
I don't know. I mean, I think it's certainly true that regulators were nowhere to be seen. I mean, this is Deutsche Bank is a great kind of parable for this epic failure of regulators in the U.S., in Germany, the U.K. less so actually, but at least in this particular case. And yeah, this is a peculiarly American saga at this point, because this is a bank, a foreign bank trying to make a name for itself with the richest of the American rich in the middle of New York, and people don't know Deutsche Bank's name. They can't even pronounce it. It's
Right.
like they've really struggled to make a name for themselves. And here comes Donald Trump, the guy who is the star of The Apprentice and is very famous for good reasons and bad. And it's very enticing if you're a foreign bank trying to make a name for yourself and establish yourself in a country like the U.S., to kind of throw caution to the wind. And I think the better argument in Deutsche Bank's defense here is that this last batch of loans that Deutsche Bank did, which went from 2011 through 2015, so leading up to his presidential campaign, was about $350 million of loans over that 4 or 5 year period. And those loans actually were probably not horrible credit risks, right? And Trump, one of the concessions that Deutsche Bank extracted out of him for these final series of loans was that he had to provide personal guarantees, basically comprising the vast majority of the loans. And so through a combination of pledging his personal properties as collateral or just having tens of millions of dollars in wealth management accounts of the bank that were presumably seizable if he were to default on the loans, from a purely credit risk standpoint, these loans were probably pretty safe. And indeed, there's no reason, we don't actually know what their status is today in 2020, but we have no particular reason to think that he hasn't kept up with the payments, other than the fact that that's been a pattern of his, of not keeping up with the payments. But probably from a purely dollars and cents standpoint, those were prudent loans, and they weren't very high interest rates. In fact, they were quite low, but they charged a lot in fees, and Trump had to keep a bunch of money in wealth management accounts at the bank, which also generated fees for the bank. And what that pure dollars and cents calculation does not count for at all are the reputational risks associated with doing business with someone who is, a consistent default risk, and who, at the time these loans were made, was exhibiting some personality traits that frankly were not desirable for other banks. And whether he was engaging in demagoguery, he was accusing Obama at that point of not being American born and therefore being an illegitimate president. And those were things that other banks, when Trump would come by periodically to see if he could get money, they were aware of the public profile this guy had. And especially after the financial crisis, banks had become much more attuned to the reputational risks associated with doing business with people that were going to be in the headlines for the wrong reasons. And Trump triggered those red flags. But for Deutsche Bank, they were so interested in, they're viewing this, first of all, through an entirely financial prism, not a reputational one at all. And they were really looking at it in the short term, once again. And from a short-term financial perspective, these loans made sense.
I want to think about the whole narrative arc here in terms of Deutsche Bank as potentially emblematic of the financial system, and how a bank like this with lax controls and this ROE target that's unreachable can continue to go on. My understanding is that when the financial crisis happened, Deutsche Bank actually came out of the crisis relatively well, that it seemed that they were doing well. But then by the time we get to the European sovereign debt crisis and beyond, suddenly they're the sick man of Europe.
Yeah.
What happened in that time frame, and how does it fit into the whole concept of they're taking on too much risk?
Yeah, that's a really good question. I mean, so Deutsche Bank enters the financial crisis with one of the biggest shorts on the U.S. housing market of any bank. Goldman kind of rivaled it for a big short, but it was the bank's traders had anticipated correctly the collapse of the U.S. housing market, and a bunch of trading desks at Deutsche Bank made billions of dollars in profits off of that, which largely but not entirely compensated for the huge losses they, like many other banks, were suffering. So Deutsche Bank did emerge from the crisis with it had a relatively good crisis. It was in a relative position of strength. It also turns out many years later, after the fact, you can look back And they appear to have been playing some really ridiculous accounting games with the valuation of derivatives and other assets, that if they had been accounting for that in a, I don't want to say a more honest way, but in a more traditional way, their finances would have looked a lot worse at the time, and they may well have required a government bailout. But as it turned out, they didn't require direct taxpayer assistance. They got a bunch of loans from central banks, and some of their trading partners got bailed out. But they came out of the crisis at or near the top of the global financial pecking order, which was quite an accomplishment. And it led to, I mean, Joe Ackerman, the CEO at the time, and some of his underlings, including Anshu Jain, who would be his successor, were extremely proud of the fact that they had emerged relatively unscathed from this once-in-a-century crisis. And, that pride contributed directly to the catastrophe that ensues, because they come out of the crisis feeling really good about themselves, mistaking their luck for skill to a large degree, and they forego this golden opportunity they've been given to kind of fortify themselves. They do not invest in upgrading their technology or upgrading their compliance departments. They do not take this opportunity to rid the bank of these hundreds of billions of dollars of risky, and really very risky, in some cases very illiquid assets that are polluting the balance sheet. They don't take this opportunity from a position of strength to go to shareholders and say, look, we survived without taxpayer assistance. That's great fortune for us, but right now we need to fortify ourselves and bulk up our balance sheet, and we need to, or not bulk up our balance sheet, bulk up our capital, and we need you guys to pony up more cash. And instead, they spent what money they had on growing fast in risky areas, especially in the US market and emerging markets as well. And at the same time, all these other banks that had been hobbled by the crisis, especially in the US, were forced by the Bush and then Obama administrations to take these hundreds of billions of dollars in taxpayer capital, which were extremely controversial at the time, but ended up not only saving the American financial system, but also getting it back in order at a pretty rapid pace, all things considered. And so Deutsche Bank went from being the survivor of the crisis to be, in a period of months, to being the sick man, because all of these American banks had been recapitalized. They'd been forced to consolidate. They'd been forced to clean up their balance sheets. And Deutsche Bank, not having received any government assistance, has a relatively thin capital cushion and is not facing any pressure from Germany or anywhere else to slim down, curtail risks. And instead, it seizes what it perceives as an opportunity to basically take over the world. And it just goes way too far in that direction, way too quickly. And then the European sovereign debt crisis hits, and Deutsche Bank has exposure all over Europe, and Greek government bonds were kind of the famous case because of the Greek government's instability and precarious finances. Those were paying very high yields, which made them very attractive to a bank like Deutsche Bank, which is trying to goose its returns.
Right.
And so they were one of the biggest owners of Greek government bonds, which ultimately, and you know the story, they basically get wiped out, or there's a huge risk of them getting wiped out. And at the same time, investors newly attuned to the risks of leverage and derivatives from the crisis are taking a much closer look at Deutsche Bank's balance sheet and realizing that this is an institution that pre-crisis had a 50-to-1 leverage ratio, and that had trillions of dollars on its balance sheet, not counting the trillions of dollars of off-balance sheet derivatives they had. And they're looking at this and saying, oh my God, this is terrifying.
And by then it was basically too late, because number one, the no bailout clause was pretty much everywhere. We're not going to bail out these Italian banks, so we can't bail out Deutsche Bank.
Right.
That is no taxpayer money. There's no TARP for you guys. That's
well, at least not with wiping out your equity.
Right.
Right. So you can bail them out, but the first step is going to be to put the stock at zero, and that is a very scary proposition for a bank or for its executives who are holding lots of stock themselves, and it's the risk of that is extremely destabilizing for a bank, because it means that touching that bank financially, you carry a risk of being completely zeroed out, which is not an attractive risk, especially given the returns were not very high. And Yeah, so Deutsche Bank, there was a small window of opportunity Deutsche Bank had right after the financial crisis that it could have taken and probably saved itself. The seeds of destruction had long since been planted and were all they were under the ground, starting to spring up into these huge plants. God, this is not a good analogy probably, but instead of uprooting those seeds of destruction, they watered them happily, and it was just out of control in really in a matter of months, honestly, even though the catastrophic nature of this didn't become entirely clear for a couple of years.
So where does Deutsche Bank go now? And what does it say about what needs to happen to the financial system as a whole as it stands right now?
Well, now in 2020, the bank and its executives is a new management team in place, and it is scrambling to save itself, really. I mean, last year they seriously considered merging with Commerzbank, which was at that point the number 2 German lender, and that was a merger that was being brokered by the German government because they're trying to save these 2 very sick banks. And those talks ended up falling apart because people realized that merging 2 big sick banks together was just going to create
one big sick bank.
One very big sick bank, not one big healthy bank, which is.
And that's what the Japanese did after their crisis, and that didn't work out so well.
No, I mean, that's not a recipe for success, right? The recipe for success is ripping off the Band-Aid and taking your painful medicine and getting it done with and hoping that you're doing it at a time where you have the breathing room. I'm mixing metaphors here, but you have the breathing room to be able to do that effectively. And Deutsche Bank did have that opportunity, didn't take advantage. So now it is racing to shed assets, shed employees, shed business lines. It's trying to retreat to its kind of German roots and be a European lender to European companies. And that means shutting down a lot of its Wall Street businesses and a lot of the businesses in the city of London. The bigger problem, though, I mean, there's a few problems that Deutsche Bank faces that I'm not sure are surmountable, to be honest with you. I mean, one of them is that they just have these still mountains of very risky derivatives and other assets that they do not know what to do with. It's not selling them means they'll have to recognize these huge losses that could essentially bankrupt the bank.
And is this a bankers trust thing, a legacy of bankers trust, or because that whole derivatives culture came from that acquisition?
Yeah, I was going to say it's certainly a cultural legacy. I'm not sure it's the financial legacy. I mean, I think that's very much of Deutsche Bank's own doing, but it's certainly a cultural legacy of having bought this derivatives-crazed bank at the end of the 1990s, which was a $10 billion deal that very quickly became a $10 billion albatross for the bank. So they've got this huge problem, this legacy problem of all of this garbage on their balance sheet that not only is it hard to get rid of, but if they do succeed in getting rid of it, creates a big financial hole for them. That's problem one. Problem two is that it's very questionable whether they have a viable business model going forward.
Right.
I mean, their German business, the whole reason they got into Wall Street in the first place is that the German business wasn't making any money.
Right.
It's not profitable. And in part because Germany is notoriously overbanked. There's thousands of banks in Germany serving a very frugal, savings-friendly customer base of both individuals and institutions. And so that's just it's not a great place to be doing business. There are all sorts of economic questions about Germany and Europe as well, obviously. So the business model is another problem. And the third problem, which in some ways is maybe the greatest problem, I think, is a cultural one, which is that this is a bank with tens of thousands of employees all over the world, and many of those employees have been very well trained over the years to do one thing and one thing only, which is maximize short-term profits. And they are not trained to think about this from kind of flipping the camera angle and looking at this from kind of a self-preservation standpoint. They're looking at this and are compensated for making money quickly. And if those incentives switch radically, why work at Deutsche Bank? And last year, as I was reporting on this book, I went down to Jacksonville, Florida, where Deutsche Bank has its big compliance and anti-money laundering operations. And I spent a few days down there talking to a lot of either current employees or recently departed employees, and just asking them how it was doing their job. Did they feel good about it? Are there problems? And it was interesting. I mean, I talked to probably 20 people, I'm guessing, and I heard one variation of the same thing from literally every person I spoke to, which is that people felt that they were being set up to fail by their managers and by executives up the food chain. And the reason was that they were being pushed to just churn through transactions. They were not being encouraged or incentivized to take their time and dig deep and err on the side of caution. They were being incentivized to do the exact opposite of that, to clear as many transactions as they could, as quickly as they could. And the employees viewed that as just setting them up not only to fail, but setting the institution up to fall into more money laundering problems or bribery problems or tax fraud problems and whatnot. And those are the kind of little scandals that bubble up that can really have enormous problems for the bank in the long term, especially in the U.S., where it's on very, very thin ice with American regulators who, this is a foreign bank that operates in the U.S. at the pleasure of American authorities, and there's no guarantee that American authorities will continue to cut the bank a break at this point. And how it's the people in Frankfurt who are running the bank right now, they are well-intentioned and they're working hard, and I think they get it, but it's not easy you can't just say, okay, we are going to have a different, better culture now, we're rebooting, we're returning to our roots as a proud, national, kind of iconic German bank, let's start over. It doesn't work that way. You need to get people, mid-level managers and low-level employees, all the way up to the kind of sales and trading people on Wall Street in the City of London. You need to get them all to change the way they're thinking about their jobs.
And it's taken 30 years for them to get to that position.
Exactly.
So it's going to take a long time to undo that.
Yeah, and I don't know that they have the time or the capacity to succeed in doing that. Maybe they do, but it's far from a sure thing. This isn't like one of those just like slow turnaround efforts that we know is going to get there because they're providing something of value and it's good for the world. This is a company operating in a highly commoditized business, far from its home markets, in a really overstretched way that has had disastrous results. You could make an argument that there's not a clear reason for them to exist.
I like that last line, actually. If you were an analyst, I guess you would put a sell on Deutsche.
Well, the thing is, their stock is down. It's remarkable. I mean, I haven't looked in the past couple of days, but it's down about 95% from its peak. So there's not that much further down for it to go, honestly. I mean, this is not a company the stock has been like riding high. It reflects these deep kind of existential investor doubts about its viability.
So, at some point earlier, we were talking about Wells Fargo. I thought immediately about companies like HSBC, various other operators out there that have been involved in scandals similar to Deutsche Bank. And so Deutsche is not really the only one. There are others.
Sure.
So when you talk about the three challenges that Deutsche faces, how systemically do you deal with that when there are all these other companies that have similar, if not as deep-seated problems?
Right, and I would say the thing that distinguishes Deutsche Bank here is that it's not like it's fallen into one or two scandals. It's been at or near the center of just about every major financial scandal in the world in the past 15 years, which is really quite a remarkable feat. How do you change that for an industry? Man, I don't know. The simplest kind of way to talk about it, but I don't know that this works, is through policymaking at a government level or a central bank level. And you cannot fiat cultural change, but you can change or require changes to compensation systems, for example, that would do much more to reward a performance of an overall company or as opposed to individual traders or even a trading desk. For every solution like that, though, there's almost inevitably a million ways to exploit it and to find loopholes, not to mention unintended consequences of doing that. We've seen that in the UK with some of the compensation rules that were introduced after the financial crisis there that have led to base salaries have gone way up and the fixed or the variable portion of people's pay has gone down. And is that really, and that's not necessarily a good way of doing things either. You can argue that, and I think, in fact, you should argue that there should be higher capital requirements, tougher leverage ratios, and basically should discourage banks from operating as just these risk-loving institutions as long as there is this presumption that governments are going to come bail them out in a crisis. Because right now, it's a very kind of asymmetrical risk proposition for a bank. I mean, or for a bank employee, even more important, if employees are getting kind of a cut of what they earn for the bank, and they let's say their group earns $1 million, and they're getting $100,000 of that cut, on the other hand, if they lose $1 million, it's not like they're losing $100,000. They get zero. And so it's a very kind of lopsided incentive structure that encourages you to shoot for the moon and not be particularly cognizant of the risks.
And you don't, and it's not like there are any clawbacks per se. You know, there's the whole thing: IBG, YBG. I'll be gone, you'll be gone.
Exactly.
When this happens.
Look, clawbacks have become more prevalent in the industry, and I think that's very healthy. And look, I think the industry, by and large, has made important strides since the crisis to reduce risk. And it's not because the banks are like acting morally or ethically. It's because they're responding to investor demands and regulatory demands that their behavior change, or otherwise people won't invest in them, or they'll make it much harder to operate. So, look, I mean, I think you can, around the edges, it's easy for regulators or investors to kind of push for a more conservative, kind of leaner approach to banking. Banking shouldn't be that profitable, honestly.
I was going to say, I mean, what countries have successfully made the transition? The first country that came to mind for me was Switzerland. Because when you think about Credit Suisse and UBS, they were really at the center of the banking crisis, write-downs out the yin-yang, level 3 assets, you know, topping up their balance sheet in order to, you know, their capital. And now they're all about wealth management. They're all about, you know, simple banking. They're really not about taking risks.
And that's partly a response to sky-high capital requirements in Switzerland that have just shifted the profitability of different business lines and made it so that sales and trading is just, it's way too expensive from a capital standpoint to be worth doing. And yet they have, in part because of Swiss bank secrecy laws and tax laws, have a natural kind of long-standing competitive advantage in the field of wealth management, in part because of Switzerland's legacy of hiding assets for people. I mean, another example would be Iceland, which has went from, you know, no one really cares about Iceland because it's Iceland, but it was the epicenter in a lot of ways of the financial crisis, in that it went, and this is essentially a fishing economy, that became, the economy was financialized, and these huge banks rose out of nowhere and then collapsed because they were built on just, in some cases, fraud. And Iceland, instead of, you know, just increasing regulation of the banks, took things a big step further, which is that they pursued criminal charges against a lot of the bankers at the tops of these institutions, and they succeeded, and these people went to jail. And you know, laws are what they are in different countries, but the act of personally punishing people at the tops of these powerful institutions, that is a deterrent. If a banker is scared, not just about missing out on a bonus or worst case scenario, losing their job, but is instead scared about their reputation being destroyed or their freedom being taken away from them, that is a very strong reason to reduce your risk-taking, whether it's cultural risk-taking or financial risk-taking or whatever. That provides you a very strong incentive to make sure that not only are you're operating within the law, but that 10 years later or 5 years later, looking back in hindsight, and when investigators are digging through your emails or your chat messages, that there is not going to be any prosecutor who could even argue that you were violating the law. It really, that would change behavior in a very powerful, I think pretty rapid way, honestly. Now, again, we live in a country and society that has laws and respects the rights of defendants, and as well we should. But prosecutors in the US in particular have been just very, very reluctant to pursue high-profile criminal cases against people in the finance industry. And that is, I think, part of the reason that there's been such populist anger over the past decade toward the financial and political class in this country. That it seems like a lot of people's lives were ruined by the actions that banks took, and almost no one at the top of those institutions was held legally accountable for that.
Okay, so let me just play devil's advocate here for a second with regard to Trump. The question is, if you're a devil's advocate, you would say, actually, Deutsche Bank, as you rightly point out, is an institution that's not well known in the United States. They're trying to make business in America, and so they take risks there, and the controls that are deficient there are only in the United States. That had the same thing happen in Frankfurt or London, it just wouldn't have happened that way.
Yeah, I mean, the special thing about Deutsche Bank is that it managed to create these problems all over the world. So, I mean, there's actually a similar situation to Trump that Deutsche Bank had out of its Frankfurt offices. There was a real estate developer in the mid 90s named Jürgen Schneider who was developing shopping malls and the like. And Deutsche Bank was one of his primary financial enablers. And in fact, some of the shopping malls he was opening were literally across the street from Deutsche Bank's headquarters in Frankfurt. And Schneider turned out to be a complete fraud and ends up, I believe, getting in a lot of trouble for that. And Deutsche Bank is caught essentially with its pants down. And they had made huge loans that they had very little recourse on, and they got wiped out on those loans. And so this is around the same time they're getting into bed with Donald Trump. And the circumstances in the US and Frankfurt are different, but this is clearly an institution that was throwing normal kind of credit underwriting, blocking and tackling skills, throwing it to the wind. And look, it wasn't just in Germany either. I mean, the bank was starving for profits all over the world and very hungry for the profits all over the world, I should say, and was doing whatever it could to satisfy its ravenous appetite. And so you look at a place like Russia, where the bank had operated for most of its history. You know, it goes back to the 1800s, where it was financing railroads for the Tsar. And Deutsche Bank took a lot of pride in Russia at doing whatever it took to satisfy its clients. And by the late 90s and early 2000s, through most of that ensuing decade, what its Russian customers wanted were money laundering or capital flight services to get their often ill-gotten rubles out of Russia and into foreign currencies like dollars or euros. And so Deutsche Bank set up a very elaborate money laundering scheme that enabled its Russian oligarch clients and others, including a bunch with direct connections to Vladimir Putin, to get their money out illegally. And this was, as were many of Deutsche Bank's schemes over the years, this was a great business for them. There were there were very few other banks willing to take that kind of risk for the obvious reason that it was illegal. But Deutsche Bank was minting money on this, and they were doing well over $10 billion of money they got out of Russia in an inappropriate way, and they were charging huge fees for the privilege of doing that because no other bank was willing to do this kind of business. And so Deutsche Bank, in this relentless pursuit of profits all over the world, kind of stumbles isn't really the right word. They go pretty deliberately across the line over and over and over again. And the result in the short term is that it's extremely lucrative. The result in the long term is that they face massive government penalties, in some cases criminal prosecutions, and their reputation gets annihilated.
Well, you know, one thing that I think is interesting when you talk about the money laundering is the connection to Trump, in that as soon as you speak of money laundering of Russians, I think immediately of all of the assets that he has in Miami and other places where, you know, these companies, I mean, did you uncover any sort of connection between these money launderers and the Deutsche Bank connection to Trump at all?
So what I uncovered, there were a couple of things I uncovered that are not exactly fitting that bill, but in the ballpark. And one was that in the mid-2000s, when Trump and some of his real estate partners were trying to build big resorts in places like Hawaii or Baja California, Deutsche Bank organized events for them in London and elsewhere, where Deutsche Bank brought a lot of its wealthy clients out to meet Donald Trump and his development partners. And some of those clients, who ended up buying big blocks of condos in these planned or actual developments, were wealthy Russians, including some with connections to the Kremlin or to Putin himself. And so, look, I have no evidence or even real reason to believe that was money laundering, but it was certainly Trump doing business with anonymous shell companies that were ultimately owned by people that had very close ties to the Kremlin and who had made a lot of money in a period when a lot of wealth was going to a very few people in Russia. So that's thing one. Thing two is that in around 2015, 2016, 2017, so this is before, during, and after the presidential campaign, the anti-money laundering specialists in Deutsche Bank's compliance offices found a number of what they regarded as suspicious transactions in the Trump accounts and also the accounts of Jared Kushner and his companies. And some of these involved money that was being moved from those accounts to the accounts of wealthy Russians.
Right.
And that was enough for the compliance officers at Deutsche Bank to think that this needed to be reported to the government as a potential money laundering risk. And so they type up the suspicious activity reports the way they're supposed to. And normally it's kind of just you err on the side of submitting those reports rather than not submitting those reports. In this case, it went up through a couple levels of management at the bank, and the decision was made not to file the suspicious activity reports. And that was alarming to some of the people inside Deutsche Bank in the compliance department, so much so that they complained about it, which is not a recipe.
Whistleblowers, basically.
Yeah, and that's not a recipe for longevity at Deutsche Bank. And sure enough, at least one of these people who spoke up and was very alarmed about this got transferred out of that division, and then in 2018 was fired. And so, look, there is a tremendous amount of smoke linking Deutsche Bank to Trump to Russia. I wouldn't say there's fire, but there's a tremendous amount of smoke and a lot of circumstantial evidence.
And so that might be one of the reasons that he's like, stay out of my finances, because, that's back then, and I don't want to open that up.
And look, this is about to come to a head, because Deutsche Bank, last spring, these two congressional committees controlled by Democrats subpoenaed Deutsche Bank for all of its Trump records, essentially, and including not just Trump's tax returns and bank statements and balance sheet information, but also any internal records Deutsche Bank had about potential money laundering concerns or things like that. And the Trump family, as soon as those subpoenas were issued, sued Deutsche Bank to prevent it from complying with those subpoenas. And so this litigation has been kind of working its way through the federal court system, and two federal courts have ruled against the Trumps and ruled that Deutsche Bank does need to comply with these subpoenas. The Trumps appealed to the Supreme Court, and the Supreme Court is about to hear oral arguments on this, and there's a decision expected by June. And
ooh, that's very bad timing.
well, it depends on your perspective, I guess, right? It means that if the court upholds these lower court rulings, which there's no guarantee will happen, but if it does, Deutsche Bank presumably is going to be handing over troves of detailed financial information to Trump's bitter enemies in Congress.
Right.
And that is, look, we don't know what's in those files exactly. We don't know if it's we just have no idea what's in there.
Right.
What we do know, and the whole world can see very clearly, is the vigor with which Trump is fighting to prevent these records from being disclosed. And that suggests that there's stuff in there that he is very worried about seeing the light of day. Now, that could mean anything, right? That could mean that, maybe he's just not nearly as wealthy as he's kind of purported to be. That's kind of on the benign end of things. On the other end of things, maybe there's stuff in there that shows some unsavory business partners overseas, or shows him not paying taxes, or who knows? I don't want to speculate, but there's no question about how Trump has been fighting tooth and nail to keep this stuff out of the public domain. And to me, at least, that suggests he has something that he is worried about getting out.
Right. So when we think about Deutsche Bank as an institution overall, faulty in terms of their structure and hopefully fixing it, what character comes out as someone who, I know in your book there's a character that comes out as, yes, this is the sort of person that we need to have at that institution.
Yeah, so there's a man named Bill Brooksmith who is kind of one of the, I would guess he's the protagonist of the book in a lot of ways. And Brooksmith was the son of a minister. He was raised in rural Illinois and got into the banking industry as an expert in risk management and derivatives. And he joined Deutsche Bank as the first wave of people to come over from Merrill in the mid-1990s. And he was kind of the right-hand man and actually best friend of Edson Mitchell.
Oh, yeah.
And Bill kind of climbed up through the ranks. Edson dies in a plane crash in 2000. And Bill, after a break from the bank, comes back. He's close with Anshu Jain, and he becomes one of the most senior risk executives at the bank. And Brooksmith developed a reputation in the bank as being this rare character with just very strong principles. And he was someone who had the credibility to not only say no to transactions, but to do it in a way that people really generally respected what he was saying. And he was viewed internally as kind of the ethical compass of the place for a long time. And this kind of, risk managers there would view him as this voice of reason in this insane organization that they worked for. And so he climbs up through the ranks. He's at or near the very top of the bank for a long time. And then in January 2014, he's found hanging in his apartment in London. And so the book really uses him in his kind of rise and tragic end as the symbol really for how the bank started off with these really good intentions. And Brooksman was someone who was a pioneer of the modern swaps market and really envisioned derivatives as a tool to help clients hedge risks.
Right.
And really, and that's a great kind of a revolutionary device that really changed the way big businesses worked in America and around the world. And he watched as this product that he had pioneered morphed into something that was much more of a vehicle for financial speculation than it was a hedging, a kind of a defensive hedging mechanism for companies. And he became very alarmed at some of the stuff that he had been seeing in the bank. And so the book traces, after his death, the kind of quest that his son goes on to figure out why his father committed suicide. And one of the things his son finds is that Bill had been using his Yahoo and Gmail accounts to send and receive thousands and thousands of Deutsche Bank related emails. And so there's correspondence with the top executives, there are meeting minutes, there are spreadsheets, there are loan documents, on and on and on. And so and Val, his son Val, shared them with me. And so it provides this really unusual window inside the thinking of this kind of lonely voice of reason near the top of a major and deeply troubled financial institution. And it also just shows the personal toll that some of this really took. And Bill Brooksman, near the end of his life, was haunted by what he had seen at Deutsche Bank and what he worried he had been kind of sucked into during his time there. And in my experience, at least, it's quite unusual to find a human character who so clearly illustrates the perils of this kind of modern banking machine that was created. Because this is someone with the best of intentions who got chewed up and steamrolled and kind of spat out. God, I'm mixing metaphors again. But who really became a casualty of the bank that he worked for and ultimately paid with his life.
Yeah, that's a tragic story.
Yeah, sorry, it's pretty grim, and it's very sad, and it's also sad because it's not the only person who took their own life at Deutsche Bank, and this is part of kind of a grisly pattern at the bank, which is, I don't think it's fair to pin that entirely on the bank, but there's no escaping the fact that there's a pattern there, and frankly, there's a pattern of that in the finance industry writ large over the past decade, and it shows us something is going quite wrong.
If you're ready to go beyond the interview, make sure you visit realvision.com, where you can try Real Vision Plus for 30 days for just $1. We'll see you next time right here on Real Vision.